Today we're going to talk about why the LLC meta might fail soon. My name is Leo. I help online entrepreneurs legally reduce their taxes by relocating abroad. So first off, what is the LLC meta? The LLC meta is basically using an LLC incorporated in the United States, in Wyoming, Delaware, Florida, whatever, to massively reduce the taxes that you're paying abroad. Now, the LLC, how does it work? If you're watching this, you probably know. The LLC is not taxed at a corporate level. So there is no corporation tax. So normally a company would have its revenue, its costs, the difference is the profit, and then the company would have to pay corporation tax on that profit. However, with this LLC, when they're treated as disregarded entity, which is like how they're taxed by default, all profits are passed down to the owner, who then becomes liable for the taxes on the profits of the company. So what does that mean? The company still has its revenue, it still has its costs, employees, contractors, travel expenses, whatever. The difference is the profit, but now instead of the company paying taxes on its own profit, it's you, the owner, who are going to have to pay taxes on that profit based on where you are a tax resident of. So if you're a tax resident of the UK, you're still paying UK taxes on the profits of that company. If you're a resident in, Indonesia, you're still paying Indonesian taxes on the profits of that company. And there's no accounting needed, right? The US doesn't care. They don't tax you. They only want to know how much money is going from the USA to you and from you to the USA. So there's no accounting needed, which basically makes it very, very nice for the people who have this company, because the United States basically don't care what you do with this company and you can do whatever you want. Obviously, in theory, right? You're not supposed to. So this is the difference in the payout structure. I've explained it, but we'll just go over it. On the left is a sole trader. When you're a sole trader, you are the business and you have to pay income tax on everything you make. If you're resident in UK, again, it's UK income tax. If you're resident somewhere else, it'll have its own income tax. With a normal company, the company pays corporation tax and then it pays out dividends. With the LLC, it's basically the best of both worlds because it has no corporation tax, but it still has legal personality. Obviously, assuming that you keep personal and business expenses separate, because otherwise it's useless to even have a company. How is it taxed? It has no corporation tax, but then you have to pay income tax, but then the income tax is a question mark, right? Because if you're a sole trader, in the UK, you'll set up as a sole trader, and even if you've left, you're going to have to pay income tax in the UK because you may not be a tax resident of the UK, but that's a UK business, right? It's a UK sole trade. Whereas with the US company, it's clearly a separate entity. So then it's like, okay, where are you a resident? And that's the big question mark, right? And as I explained earlier, it depends on where you're a tax resident of. Now, the loophole, right, which again, it's not a loophole, but it's exploiting rules that exist. I guess you could call that a loophole, but it's fully legal, right? Is that profits from operations come into the US LLC. The LLC pays no corporation tax, as we mentioned. And then we make use of territorial tax systems and remittance-based tax systems, such as, Thailand, Malaysia, Panama, whatever, to not pay tax on an income level, on a personal level, when we take out the money. So the idea is £1,000 comes in, the company pays no corporation tax because it doesn't exist with this US LLC as a disregarded entity. And then because you're not remitting income into Thailand, you're not bringing the money into Thailand, you're also not paying any taxes, right? So there's this scenario where 1,000 comes in and you're paying no taxes, right? Now, what most people do is they just ignore the second part. They're just like, oh yeah, I have an LLC. And then they go ahead and spend money from the company, or they take out money and they spend without even thinking about the second step. But this actually doesn't work, right? This is just fully tax evasion. The way it works is you actually have to look at, okay, where am I a tax resident of? Because if you don't exit your old tax system correctly, then you're still liable for taxes in that old country, right? And then you still have to look at where you're a tax resident of and meet the criteria, to be a tax resident in that country and to, not pay tax in that country. Like, you need to be careful. There are clear rules around remittance that you need to know and you need to follow them. So how do we do that? We need to get out of, example, the UK tax system, or old tax system. We get into the remittance basis tax system. For this example, I've used Thailand, right? Thailand has a remittance basis system. They only tax your money you bring inside of their country, right? If you don't remit anything into Thailand, they don't have anything to tax, right? Now there's rules around remittance, what counts as remitted income. I've made videos on that, so if you want to check them out, just go on my channel, you'll find them. But this is basically the idea, right? Now, this is why it works, and I will get into why it might fail. So the reason why it works right now, at least in Thailand, for example, is because of their remote worker visa. So a lot of countries now have it. Malaysia has it, Indonesia has it, a few other countries have it. This remote worker visa, especially in Thailand, it gives you 5-year access to Thailand, right? It gives you permission to work with your online company. You can stay 183 days at a time. You can renew it for an extra 6 months. So you can basically stay up to a whole year without leaving the country. It's super cheap, and the reason why it works is because Thailand even considers this as a tourist visa, which is insane, right? Because it lets you stay 5 years. Technically, you're considered as a tourist. It's super hard to open a bank account, right? It's super hard to get a tax number. But effectively, if you're a tax resident, if you spend over half a year in Thailand, you're supposed to pay taxes in Thailand. So the fact that Thailand sees it as a tourist visa makes it so for you, they really see this company as something that's happening entirely abroad. Even if you're the sole shareholder and the sole owner, and you're just performing your work from Thailand's condo, that technically could be considered as income that's sourced locally from Thailand. In fact, this is why it may fail soon. And these are the two things, right? Management and control, and permanent establishment, right? Source income. So when it comes to management and control, it goes, I'll make it simple, but management and control and source income are rules against avoidance, basically. So it goes something along the lines of, if you manage this company from our country, then we are going to tax that company as if it were a resident of this country. So all countries have this, so at least most of them have it. In Europe, Australia, like this is enforced all the time. So for example, if you're living in the UK, you can't just set up a company in the UAE and run it from the UK, right? Because first off, the company is managed and controlled from the UK, so it'll just consider the company, even if it's in the UAE, they'll say, well, this is a UK resident company, so we're going to tax it here, right? And Thailand could do the same, technically, because you're living in Thailand, you have a company in the US, technically the company's managed and controlled from Thailand. Does this happen? No, and the reason for it is because, especially if you're on a destination Thailand visa, it's a remote worker, Thailand just assumes, that all the work is being performed elsewhere, right? Even though realistically, if, it was the UK, Australia with the same rules as Thailand, they would still get you for management and control. And this source income is something very similar. It's not the whole company, but the profits of the company have actually been generating from a permanent establishment, which for our sake, it's usually like an office or a factory, something like that. But obviously for us, kind of works as a place of management, right? There's a place of management in Thailand. All the income producing activities have been sourced from this country, so we want to tax it in here, right? These are the two rules whereby you'd have to pay taxes in Thailand. Like if everything was enforced to a T, it wouldn't work to have just a US company with no substance in the US. Now, the reason it works, again, you're on a tourist visa, basically it's gonna be fine, right? And again, just to drive this home, if Italy, Australia, the UK, Canada, they had the exact same rules as Thailand, as in remittance basis, right? We don't tax money that's not coming into here. If you did the exact same things that you do in Thailand, UK, Canada, they would get you for these things, for management and control and for source income. So it's basically, we're waiting for Thailand to enforce this stuff, if that makes sense. Then it is very broad, like we don't have physical offices, it's all, working online. Remote work only really popped off after COVID, like tax regulations are still catching up with the progress of technology. So, we'll just have to see how it evolves. Now, what happens if it does fail? So new country taxes you. So again, we're using Thailand as this example. It can be whatever. Like what happens if it fails and new country says, actually, the company, all the profits are sourced from here. So what's going to happen is all profits are attributable to a permanent establishment in Thailand, therefore you pay Thai tax on all income. That's what can happen. They're like, okay, income is sourced from here, you live here, there's no management abroad, you are the only one who produces income is sourced from Thailand, Thai tax on all income, which goes from 0 to 35%. Then the second one is management and control. They're like, the company is managed from Thailand, so we'll tax it as if it were a Thai company. So all the money you spent personally is then taxed again as Thai income tax, right? So you have Thai company and Thai income tax. So you basically don't want this happening, right? Again, the second one especially, it's going to be like, I doubt this is going to happen in real life, but it's something that you need to keep in mind. It's like, if this company is managed from Thailand, if Thailand goes, this company is managed from here, like, they're not wrong. Like, you don't have anyone in the US. You've got like a mailbox as your US address. So if they wanted to, they could tax it as a Thai company now. So yeah, you don't want this happening. Now, is this going to fail? Are they going to get you? I don't know. You just need to know about the risks that you're taking on. Source income, permanent establishment, management and control, these are all real things. Now, are they enforced? Not yet. Will they be enforced? Who knows? Now, what if it does fail and your old country taxes you? So this happens when your tax residency is not broken correctly. You set up your LLC, maybe you're Australian. Australia has very long rules about how to get out of their tax system. Basically, they'll still tax you unless you can prove that you've relocated somewhere else, like permanently. So when your tax residency is not broken correctly, the tax office says, well, you didn't exit our tax system correctly, therefore you're still a taxpayer in our country. And as I explained before, with the tax system in the LLC in the US, all profits of the LLC are taxed based on your tax residency, right? And if you're still a tax residency of your home country, then all the profits of the LLC are going to be taxed in your home country. And all the business expenses that you pass through the company are now checked to see whether or not they were actual business expenses. And if not, they'll disallow them and add them back to your taxable profits. So let's say you had 100K in revenue, 50K in expenses, but only like 20 of them were legit. The other 30, they say, well, no, this is actually not a business expense. They'll add it back to your taxable profits. You're gonna have to pay taxes in your home country. This is just a mess, right? But it's easily avoidable by just breaking your tax residency correctly. Like, forget source income, management and control, permanent establishment, like CFC. Like, we just want to get out of the fucking tax system. And this is the most important thing you need to do. And make sure you do it correctly. Make sure you break tax residency the correct way. Like, go and look at the rules in your country and make sure tax residency is broken. Because once you break tax residency, then, you know, the world is your oyster, because you can relocate to all these new countries. You got Thailand, you got Panama, you got South America. Like, there's loads of places you can relocate to that are tax friendly, that a lot of times don't even enforce the management and control and the source income. So be careful, break your tax residency correctly. Now, I want to give you an extra layer of protection if we want to be 100% certain of this working, because now, obviously, if you're starting off, you don't want to have like complex structures or, you know, fancy things. Like, an LLC does work, right? You also need to think about risk to reward. The tax office works like a business as well. So if they know they can get back 20K in taxes, they're not going to invest 50K in resources, because it wouldn't really make sense. Whereas if they know that someone's making loads of money and they could get back potentially 200K in taxes, they're going to be willing to invest like 40K, 50K, even 100K, right, to get that money back. So think of the tax offices as businesses. The more money you're making, the more you need to be careful and make the case airtight. So this is actually a way to pay 0% tax and have it completely legally. It's going to be very expensive though, or at least more expensive than what you're currently doing. So we're still going to have the operating company, okay, here, bottom left. And the operating company is going to be held by a holding company in Panama, or, you know, a zero tax country like, you know, the Cayman Islands, the British Virgin Islands, Hong Kong. So Panama and Hong Kong have a territorial tax system. So if no operations go on there, then they don't pay any tax. So basically you have an LLC, you have a holding company in one of these countries, and then you own the holding company, right? And this is the money flow. So the LLC pays 0%. Passes up to the holding company, pays 0%, holding company pays you 0%. But we need to create substance. Like, that's the main issue. The main issue is that there needs to be substance in this company, because otherwise it's the same thing. If this is just a box and this is just a box and there's no one in Panama, like, you've got no physical office, no utility bills, no employees, then is this going to be the same as if you don't have this? Like, you could have 5 boxes here, 5 companies, but if it's just you managing the whole thing, then your structure is just not going to work. So this works, but you actually need to build substance in this company. So like in Panama or in the Caymans, in the BVIs, and actually have an office, which is going to cost you a little bit depending on where you are. But like Cayman Islands, you know, they're expensive. There's people who do this all the time, so it's expensive. You might want to have a director over there, or some staff, some kind of activity, so that you can prove that it's not just a box, but there's actually operations over there. So if you do it like this, it's more expensive because you need to like have an office in Panama, and you need to have maybe like a director in Panama or like someone working in Panama, and you know, pay your utility bills and stuff, and maybe have board of directors meetings. You can get into that in another video. But if you do that and you can show substance in this country, then this structure just works, right? It's just clean, super clean if you're location independent. And then obviously when you take out money, you need to be careful depending on where you live. But this structure works, and this can work even when you're making like hundreds of millions. This structure is just clean, there's substance. This is like what you're supposed to strive for with an operating company, a holding company with substance. Like once you've got that, you literally do not need to think about anything else. Like there's operations and stuff. Obviously the way I like to work again is with risk to reward. So obviously if you're making 50K, you're not going to go and, you know, slap a holding company in the Cayman Islands, right? Again, as I always preach, the more money you make, the more you want to make your case airtight. Spend less time in your home country. Build more substance in your new country. Build substance where the holding company is incorporated, and open another bank account that's somewhere else. And if you follow those steps, you're going to be fine. Thanks for watching. If you want to talk with me one-on-one about your personal situation, you can book a consultation call using the first link below. Thanks for watching. Bye-bye.